Welcome to The Explainer. So here's a classic Wall Street puzzle for you. How can a massive software company beat its profit goals, announce a huge stock buyback, and then watch its stock have one of its worst days in years? It sounds crazy, right? Well, let's get into the very strange case of SAP.
Okay, so let's set the scene here. It's January 29th. The German software powerhouse SAP drops its latest earnings report. And at first glance, the numbers looked pretty good. But the way the market reacted? Whoa, it was something else entirely.
And by something else, I mean it was absolutely brutal. SAP stock just plummeted, down over 15% in a single day. We're not talking about a little dip here. This was its biggest drop in years, and it wiped out billions of dollars in value, just like that.
But here's what makes this whole thing so weird. The main number that Wall Street really cares about, earnings per share, was actually a beat. SAP made more money per share than all the analysts thought they would. So that's supposed to be good news, isn't it?
That is the big question we're digging into today. Why in the world did a report that looked positive on the surface lead to such a massive sell-off? The answer is kinda buried in the details, and honestly, it tells you a ton about what investors are really looking for these days.
So to really get this, we have to start with the positive story SAP was trying to tell. Because before things went south, they actually shared some news that was, on paper, genuinely impressive.
First off, they were shouting from the rooftops about their total cloud backlog, which hit a record 77 billion euros. Now, you can think of the backlog as all the future money they already have locked in from contracts. Seeing that jump by 30%, that's a huge signal of really strong long-term health.
And it wasn't just that one number either. The company looks super healthy all around. They beat their own profit goals, beat their cash flow goals, and then they guided for even more cash next year. On top of all that, they announced a massive 10 billion euro plan to buy back their own stock, which is, a classic way for a company to say, we're confident in our future.
And this wasn't just abstract financial stuff. They were showing real, tangible momentum, name-dropping huge new customers. We're talking about massive global brands like L'Oreal and H&M, and even a huge government contract with the US Navy. These are big players all signing on the dotted line.
Okay, so you've got all this good news, right? All this positive momentum. But it turns out, investors just completely ignored all of that and zoomed in on one very specific little number that told a much more worrying story, at least in the short term.
And here it is. This is where the panic started. Remember that giant long-term backlog that was growing at 30%? Well, there's another number called the current cloud backlog, or CCB. That only grew by 25%, and the problem was their target was 26%. It's just a 1 percentage point miss, but to the market, that tiny miss was a gigantic red flag. So to get why this mattered so much, you gotta know what CCB is. Unlike the total backlog, which is this big, fuzzy number about the future, the CCB is laser-focused. It's the guaranteed money they expect to bring in over the next 12 months. It's a direct signal of how fast the company is growing right now. And that's really the heart of it. The long-term picture looked great, but that 1% miss on the short-term number made investors really nervous. In today's market, everyone is hyper-focused on what's happening now. So any sign of a slowdown, no matter how small, gets blown way out of proportion. People started wondering, is growth hitting a wall? Are they struggling to close deals? It just created a ton of doubt.
Of course, SAP didn't just sit there and take it. Their leadership came out right away with what you could basically call an alibi. They got on their call with investors and said, hold on, that number isn't what it looks like. In fact, they argued, it's actually the result of some really good things happening.
So their explanation came down to two key things. First, they said they're signing bigger, more complicated long-term deals, where a lot of the money only comes in after the first year. And second, they're winning more government contracts, which have these weird clauses that, for accounting reasons, mean you can't count the money in your short-term forecast.
So, in a nutshell, SAP's CEO, Christian Klein, pretty much said, look, our actual new sales were better than we even planned. We're thrilled with the quarter. It's just that the kind of awesome deals we signed happened to mess with this one specific short-term accounting number. And this is where SAP played its trump card. To fight back against all this short-term fear, they pivoted hard to their massive long-term vision, which is all about dominating the future with what they call business AI. The CEO's whole point was simple. He said, hey, all these generic AI models are cool, but they're not what big companies need. The real value, he argued, comes from AI that's connected to a company's most critical data, their finances, their supply chain, everything. And that's data that only SAP has.
And this wasn't just some vague promise. They laid out a whole playbook for how they're going to bake AI into everything they do. We're talking a new AI assistant called Joule, AI agents that can automate tasks, and even custom AI for specific industries. It's a full court press.
And if you want proof that this isn't just talk, get this. A staggering 90% of their 50 biggest deals last quarter included these new AI products. So this isn't some far-off dream. Their most important customers are already signing up for this AI vision right now.
So what you have here, after that huge 15% stock drop, is this fascinating tug of war. There are two completely different stories about SAP's future, and honestly, you can find evidence to support both of them. So on one side, you've got the nervous investors. They're looking at that CCB miss and saying, I don't care what the excuse is, this looks like growth is slowing down. But on the other side, you've got SAP saying, forget the short-term noise, look at our massive long-term backlog, and look at how fast customers are adopting our AI. We're building a foundation to own the future.
So in the end, that whole dramatic market reaction really boils down to this one question. Was this just a weird, temporary speed bump caused by signing deals that were almost too good for the accounting rules? Or was it the first real crack in the foundation of their entire cloud strategy? Only time and, well, the next few earnings reports are going to tell us which story is the right one.